So you got all your money tied up in real estate. Or was it stocks? Not anymore. Let me start with a fundamental truth. There is no such thing as a riskless investment. I mean, even hiding your money in, on, or under your mattress has some risk. But officer, my bed, it's still in there. See? Not safe. And the Bank of Bedtime pays you absolutely no interest at all. Then there are standard savings accounts. You know, like the ones that pay you 1 or 2 or 3% interest on a really good day. Yeah, those aren't going to help you build any kind of retirement nest egg. But they are FDIC insured. That basically means you'll get your money back, because the government will print more if they have to. Of course, your money won't be worth as much then, but hey, low risk, low return. CDs have a slightly higher return, but you can't get at the money right away. And they're FDIC insured too. Then there's stocks and bonds. And I'm guessing this is what most people have squirreled away. Here's something you ought to know when you're looking at your financial portfolio. The average return on a nice stock-based index mutual fund is estimated at 10 to 12% per year. Wow. Well, it's better than a savings account. 10 cents for every dollar. That's money. For most people, that's pretty much all there is. But if you ventured a little further, you'll find strange, new, and exciting terms like venture capital, angels, and qualified investor. Angel investors are people who invest directly in small or startup companies so that they can grow or expand. Their investments generally have much more risk, and so they also have a much higher return. Venture capital firms are similar to angels, but usually invest larger sums of money later on rather than small amounts of money in the beginning. Because there's a substantial amount of risk, most angels and VCs want to be assured that the companies they're investing in have the potential to make 5 times their investment back in 3 to 5 years. That means a 400% return. Yeah, it's actually 400 because you get your money and then 100, 200, 300, 400%. It makes that 12% you're making in your 401k on stocks look pretty pathetic. That's because it is. The sooner you buy into a company, the more you can potentially make. And publicly traded stocks and bonds are the last stop on the gravy train. Welcome aboard, investor. Whoop whoop. I can see you just barely made it. Why don't you join the others and coach? But wait, if this is for real, how come you haven't heard about it before? Because there are laws about trading securities, and the government doesn't approve of ripping off naive old people, or people who don't know anything about investment, or maybe you. And so to be on the safe side, most businesses looking for investment are generally looking for qualified or accredited investors. People with at least $1 million in assets or $200,000 to $300,000 a year in sustained annual income. Probably not you. And definitely not me. Dude, last one on the gravy train again. So that's it. You're too poor. You can't even afford to get on that train. But wait, this is America. I have the right to make ridiculously crazy investments in businesses that could potentially fail and lose everything I put into them. Yes, you do. There are all sorts of private business arrangements that don't involve governmental regulations at all. But your investment advisor may not know much about it. And he may not even be able to advise you on it. For legal reasons. And if you ask your stockbroker, he'll just get confused. Private opportunities are all over the place. And they may not come looking for you, but that doesn't mean you can't go looking for them. So you have all sorts of private investment options, like your neighbor with a genius business idea, or your old college buddy who needs some funding to expand. But what if you don't have enough money to make it fly on your own? There are these little things called investment clubs, groups of people who come together and pool their money and vote on the investments they want to make. Sometimes it's just stocks and bonds, but it could just as easily be startup businesses. Investments like this are high risk, and you can lose everything. But when you see the way the stock market's going, you can lose a lot there too. Just don't put all your money in one place. Be sensible about where you invest, and maybe balance your portfolio with a high-risk, high-return angel investment. Generally speaking, risk and potential for return move together. That means if it's safe, like your mattress, you're not making much on it. But if it's risky and a good investment, then you can make a boatload. Maybe like a train load. Who knows? Maybe you'll be driving the gravy train. What? Isn't it Tuesday today? Oops.